I think we talk about it right now because I mean
Okay.
we've been rolling for a little bit,
Okay.
so I think yeah. So you
Well, I didn't think we were actually. This is going to be in the video, but go ahead.
well, I mean I think
Ready
it
when you
can
are.
be.
Yeah.
So Art Rendak, Inland Mortgage, you're the president,
Thank you. Yeah.
and I've known you for what 3, 4, 5 years now.
Uh, I don't know. We got introduced networking, and then
Yeah.
I drove you home from the Cubs game, and we were there was a lot of bonding on 290. I think
I
so.
agree with you.
Yeah.
You, but just I want to be clear though. You didn't drive me home because I needed to. We planned that in advance. Would you agree?
Yeah.
You were in my
No, you weren't.
you
You
weren't an
weren't.
Uber driver for me that night,
No,
right?
right. Yeah, that was another part of my career. No, it was. I was just.
But Allison was here.
And she was at the Cubs game too.
She was with us, and so
Yeah.
was Debbie,
Yeah.
and I can't remember who else.
That was just the four of us.
We were into
Oh, Kathy
Kathy
Ruzicka.
too,
Yeah, yeah.
but she was there, I think, with a different group and a different
I think her bank. Yeah.
something like that. All right, but you've been the president now of Inland for how long?
Oh, I get confused. It's got to be 13, 14 years. It was a very unique situation. So, my boss. Well, we were in the Great Recession, and my boss, who was the president, and I was kind of number two. He got sick. There was a lot of stuff going on with the recession. Our portfolio was in disarray. We had the lenders who lend us money, who give us capital, were hounding us. It was just a lot of bad times. He was really sick. He sort of got blamed for some of the loans that went bad.
Okay.
And I sort of picked up the pieces, and I was doing the workout anyways while he was sick. And then I sort of got promoted in the conference room one day, and he got demoted and
Okay.
he retired. But yeah. So he just passed away sadly. But yeah, I became president on the spot, kind of truly a battlefield promotion in the conference room, and I've been president ever since. And that's you've gone through, finished up, paid everybody off, which was one of my, I hate that my crowning achievement was the fact that I worked out of a lot of bad loans and paid everybody off. But it was really something. And went through the pandemic. We had no losses, so I'm undefeated since the recession on losses and things. Every loan we've made is paid back. So either I'm too conservative or I'm not making enough loans. I think I don't know. Some people.
Well, running a big company like that and keeping it, allowing it to survive is probably a pretty big feat on your part.
Yeah, it's just two crises. The first crisis, certainly that we lost money on that, but making it through the pandemic, rebuilding the team. My company, Inland Mortgage, was amazingly decided to get back in the business after the recession. The recession was very painful for the company, and we were glad to. I'm grateful that they decided to start up again. Then the pandemic came, and it was like, you got to be kidding me. And so we kind of shut down a little bit, and I think that's probably when we started.
Yeah, it was 2020, right? When
Yeah.
Allison had kind of
Yeah.
started, it was
Yeah, because we were networking on Zoom at the time. Yeah,
every Friday.
and so I thought we were done, or my group was done, my subsidiary, and because the performance of the portfolio was so good, we started back up again. So we're 2023. I don't have any people. I have to rebuild again. So I was just basically moved all the way back to 2014 when I was rebuilding a team or building a team. And so I'm kind of a little bit farther now to today, April 16th, 2024, than I was back in 23 when we decided to get back into business. But it's worked out great because we're in a position where our competitors are on the sidelines with what's going on in the economy, at least in commercial real estate. And we have capital to deploy. It's very hard to deploy it. Yeah, we could talk about that.
Well, you're respected across the industry, though. A few months ago, or maybe about a year ago, Cindy and Allison and I think Tim was there. But didn't you speak at didn't Huntington Bank hold a commercial real estate convention? What was that? I think
It was another group, but yeah, I was on a panel. And yeah, it was, you guys stuck it out. It was 5 o'clock in the afternoon
Yeah,
by the time I got on. I think we started at 1,
I think you're right.
and it was not the greatest seminar that I've ever been at. But the bar was open in the back, and the drinks were glasses were being clinked with ice, and I was trying to speak over them.
I remember. I
But for
remember.
those who stayed, hopefully they got something out of it. And yeah, I do speak on a lot of panels, and you know, I kind of like to talk about what I do. I teach a class at the University of Illinois,
What class?
real estate finance.
Okay.
Yeah,
All right.
so it's a bunch of seniors. It's an elective, and hopefully they, you know, many of them are interested in real estate. They just, there's really no major for it, and so if they're interested in the lending side of the business, they take my class, and many finance majors really don't know where they're going, so they may just start, you know, trying to get some real estate classes. They'll still graduate as finance majors, but they'll have sort of this real estate knowledge, and they'll go, you know, walk into one of the real estate companies in Chicago or St. Louis or wherever they're going, and say, "Hey, I took a few classes. I think I hopefully know what's going on." So
That's pretty cool.
yeah, I have 62 kids. Never taught before. This is my second semester.
Okay.
I'm still learning. I'm not very technological, and the kids are. I think teaching a class requires not only you to be a teacher, but to somewhat be an entertainer.
Oh yeah.
I think it's this experiential world that we live in. My sort of 1980s lecture style with some PowerPoints and cutting it. I need to have some spinning on the screen, or, you know, some strobe lights in there or
Yeah, I
something.
get it.
You know, maybe, you know, have the kids do song and dance, or me do song and dance. But so yeah, sometimes I think they tune out, and attendance has been a little.
And it's obviously all virtual. Then I'm guessing you're not.
No,
having
I
that-
go down. I go down
Do
on
you really?
Mondays. I teach live, and then Wednesdays I teach on Zoom, and it's very tough to teach on Zoom. I don't enjoy it, and I don't know if I can't figure out a way to do it live. I think I don't.
Is it just hard to teach on Zoom because like you can't get that connection? You don't know who's paying attention, what's grabbing their
It's
attention.
if there's any interaction in class, it doesn't happen on Zoom. There's very few kids who hit the chat button and say, you know, tell me about this. They kind of sit there and they're watching the screen, and it's an hour and 20 minutes, and yeah, and so by 3 o'clock, you could see if I have 41 kids on my class, you start seeing like 32, 31, 30. Yeah, so I can kind of see the participants
A little demotivating.
trailing off around 3. Yeah, so that last 20 minutes, if I make it, usually I don't keep them on the whole time. But yeah, your parents of the students, I'm not giving you all your money's worth. I do kind of take classes off around 3:10 or so if I'm done with the subject. There's no use starting anything at 3:10. Yeah, it should be an hour. I don't know. I have so much respect for teachers after this, like teachers who sit there all day with little kids or junior high or whatever. I mean, to teach that 7 hours a day, to stand up there and do, you know, basically there's some entertainment to it. You've got to be on. You've got to be controlling the class. I mean, you know, I sit at my desk, and if I feel like taking a break, I take a break, and
Right.
you know, I don't have to like think about what I'm going to say in the next 7 hours and how I'm going to keep these kids, you know, in tuned. And you know, obviously if they're interested, it helps, but that's not easy. I have a ton more respect for teachers, and I'm only teaching, you know, 2 hours and 40 minutes a week, and
Yeah.
it feels like I've got to do so much preparation for that. I don't have a textbook, so I create all the material myself, but it still feels like, my God,
It's a
I
pretty
can't-
big commitment
can't
though, to
imagine.
create all the
It
material.
is. It is. Yeah. Well, it was much harder last semester. You should have talked to me then. It was when I had nothing to start with. But you know, this semester has been a
So
little.
how do you
easier.
even land in that? Do you apply? Do you say, "Hey, I'm interested in teaching this course"? Do they reach out to you?
It's an incredible story, actually. But so I was actually on the fundraising, on the other side of the fundraising table, and the dean of the finance department, or the dean of the business school at Illinois, sat at my table after he gave his remarks, and we chatted up, and I said, you know, just kind of said, boy, you know, I wish Illinois had a better real estate group. You know, what's going on? And he's like, we kind of, long story short, we sort of talked about it, and he said some of the things that happened, and then he said, do you want to do something about it? And I'm like, hey, I'm all the money I'm giving you today is all I got, which wasn't very much. And no, he's like, would you want to be in? We need teachers. Everybody kind of left the program. It's a long story, but so there was maybe one other retired real estate guy and a retired lawyer who were teaching classes. And so just kind of snowballed from there. I got some introductions, and it was intriguing, like to give back. And I thought I could. I didn't think the drive down for 2 hours on every Sunday and driving back 2 hours every Monday would be so bad. But it gets old towards this time of the year. I've only got 2 classes left this semester live, so there's going to be a little bit of a party on April 29th when my last trip down.
Are you done this year, or are you going to do it again?
I don't know. I'm thinking, it's really the Zoom thing. I think my career is, I think things are happening at work that I'm really excited about. My real job.
Like what?
We're coming into some money. We're, it took a lot of hard work, but I think we're going to get a big slug of debt capital, and going to give us a lot of ammo to deploy, and we're excited about that. And so, we've been hamstrung a little bit. We're trying to raise money in a tough environment, and we found a lender who seems, interested in what we're doing, gets our story, and we're hopefully going to close here in the first half. Well, maybe July.
Well, the last I heard you talk, weren't you telling me that there was a lot of money on the sidelines? That seemed to be the theme of the conference that we talked about earlier, right? Money on the sidelines, money on the sidelines.
Yeah,
that's what I heard for 5
There's a
hours.
lot of capital. There's a lot of capital available for real estate, which is kind of crazy because the stock market is really a better place to be at right now. But there's always money for real estate. It's an asset class that people want to be invested in. That sort of theoretically, values don't go down. It's a little bit different with the building maybe we're in, an office. But so there's real estate money waiting for prices to settle back. And like everything, every opportunistic buyers who have capital, they're looking for those opportunities. And I think those old enough to remember 2003 or whatever that recession was, they picked up assets for nothing. The banks were just foreclosing left and right, and there was real opportunities there. Things have changed a lot. The banks have kind of gone to sort of a pretend and extend or pretend and blend.
What does that mean?
They know when they take the assets back, the values will plunge. So they do everything humanly possible to work with the borrowers. And they'll do, to the extent that the borrowers are willing to work with them.
Well, it's probably in everyone's best interest, isn't it?
Yeah, it just doesn't clear the market. I mean, it's if you believe that these cycles will eventually pass and somehow, some way you can make it work. The difference with this cycle is that, and every other time we've had a recession, interest rates have gone down, which has helped the borrower make payments. Real estate is very debt driven. So it's there's a lot of capital that's required to buy an asset. Not many people have $15 million liquid. They need to borrow half of it or 2/3 of it or 3/4 of it. So it's just the nature of the business. The assets that you buy are expensive. For those lucky enough to have $15 million or $50 million in cash, God bless them. They don't have to worry about that stuff. But usually you make more money by borrowing too. So you buy the asset and you borrow hopefully cheaper than sort of your return, and you juice your return with the debt and return on equity anyway. So that's kind of the concept. That's not really working today. But anyways, going back to the point, when interest rates were going down, at least if you can't make the payment at 6%, but let's say you're on a floating rate and the Fed drops the rate to, you're at 2.5 or whatever the bank is willing to help you with. Maybe you can make the payment at 2.5 without assistance. Either the bank lending you more money or, accruing some of the debt for later or something like that. Mm. When the rates are going up, if you can't make the payment at 5 and the rates go up to 7.5, it ain't helping. So, and if there's no new tenants or no new income to help you get that payment covered, the bank's got a problem. There's only so much of, forgiveness or pushing everything to the back end and hoping everything goes well that banks can do. That's when the examiners get and the regulators get nervous about their customers, so or their constituents. And so this is a little bit different recession, but so far, office, there's definitely a lot of office that's getting foreclosed on, but generally the other product types are not in that situation. And and industrial's fine, retail's generally fine, except for malls. Multifamily is in trouble a little bit. I think you'll see some self-storage trouble, but by far, for sure, office is in the worst shape, and nothing on the horizon that says waiting this out is gonna make anything any better. The pandemic.
Yeah.
God, how could I forget? The pandemic was just a paradigm shift in how people worked, and they got used. We conditioned them that working from home was productive and beneficial to them, and employees liked it. Some did, some don't, but I think there's many that do. And so we went from a 5-day work week being standard in the office, maybe casual Fridays or half-day Fridays in the summer or something like that, to where now it's like asking someone to work on a Friday in the office is like, they might,
the roads are empty on Fridays.
Send them detention or whatever. It's like, you've done. What did I do? Like, what am I going to be fired?
It's a new world, isn't it?
Yeah. So it's just different that no matter where you lived in relation to where you worked, you either got on the train or you got in the car, or if you're lucky, maybe you walked. But all of a sudden, that commute, that burden seems to be overwhelming, and I think employers are just are afraid to push too hard, even though there's been all these companies that have mandated, coming in, and there's a lot of people are working around it. They, this coffee badging, and I don't even know what that is exactly, but they're coming in for 4 hours, or they go to lunch, they meet a customer for lunch, and then they go home. Yeah. There's just a dread. It's just like we have to change if you want people to come in the office, and I do, but because I'm in this business, but we have to recondition employees that it's better. It's better for your career. It's more productive. Maybe it isn't. I don't know. I can't speak for everybody who works from home and does a great job, but I believe that collaborating and being with people is better. But maybe it's just me.
Well, it could be our generation too. Because
Yeah.
I feel the same way, and I get a lot of pushback. People say, "Well, I'm just as productive at home." If I were to guess, I don't think people are as productive at home. Now, at the same token, though, can somebody maybe turn the computer on at 6:15 when they would have left the office at 5 and get some
That's
work
right.
done? So there's a little give and take, I think, on all fronts. I like my staff to be here. If there's anything, there's camaraderie, there's coaching, there's one-on-ones, there's teamwork, there's collaboration, as you said. So I like having people in the office, but you're obviously in commercial lending and working for Inland. Most of our viewers know that, but they might not know exactly what part of commercial lending you're in, and that's bridge loans specifically.
Yeah.
Would you mind? So it took me.
Yeah.
I knew you for maybe a year or two before I really wrapped my brain around bridge loans, and then right when I heard you had done bridge loans, you had talked about it at one of our meetings. I Googled it or YouTubed it, and I found bridge loans that didn't seem to be necessarily tied to what you do.
Okay.
And so if you don't mind, I'd
Well,
like a
yeah.
little
So the
definition.
word bridge is obviously creating a way to get from point A to point B.
Yep.
It's probably, however you perceive a bridge, it's, you think probably easily or most common crossing a body of water or something. So you've got to, basically the bridge is sort of similar in that way, is that you've got to gap a problem. And not every loan I make on every real estate, my collateral is not always a problem. It's just not where it needs to be.
What do you mean by that?
Okay, yeah. So it's not 100% occupied, or it's not maximizing the rent. So I make loans on apartments that are 97% full, which is generally in our industry is deemed full. Anything over 95% for the most part is deemed full. There's always some people moving out and transition and all that, so you underwrite
Fair.
for that. But maybe the guy who owned it just didn't, he's leaving money on the table because he didn't want to put any money into it. And it's very common that, I bought this thing for, $200 in 1952, and it's full. I've got the same, appliances from the 50s and I got carpet in the kitchen or whatever. Uh, there's people need a place to live, and you give people a place to live, but perhaps in that neighborhood, because so much has happened since 1952, that people, gentrification or commerce has occurred, and
Yeah.
there's ability for people to move in who would otherwise not live in that complex because it's so dated, that they would pay more rent, and they, whatever the property has as a benefit, um, could be achieved with spending some money on the building. So my customers will come to me and say, I'm going to buy this thing. I'm going to tear the carpet out of the kitchen. I'm going to put, luxury vinyl plank or tile or whatever. I'm going to upgrade the appliances to today's standards, maybe put a washer and dryer in the unit if it's feasible. And I'm going to increase the rents $300, $400, $500. And if the cost to do that, the capital cost of, let's say it costs $5,000 a unit, and you're going to generate 500 in rents, you're going to have a 10-year payback, right?
Yeah.
And the
Makes
way,
sense.
so with real estate theoretically lasting longer, that would be, the return expectations are even longer in the way real estate works. But
Okay.
if I believe in that story, and think of sort of Shark Tank Junior, super light,
Okay.
someone has a business plan, they see a vision for the property that isn't there today, and we lend against it, and we provide capital to achieve their goal of what the property should be. Between their capital and my capital, hopefully, or my company's capital, will turn that 52 vintage apartment into a 2020. It still was built 70 years ago, but the inside of it and maybe some other things are modernized. There's some tuck pointing. It looks better. It's got some curb appeal on the outside. Maybe the amenities are updated, that the pool or whatever it is, if there's one, and the inside is definitely more modern. And so you do the best you can. You're never going to get, the top of the market rents for a 52 built product,
Understood. Yeah.
but you hopefully go from whatever that guy was getting, the seller, to whatever, can be achieved at this property.
So I don't want to embarrass myself, but why not just do a revolving commercial line of credit for that remodeling? And I'm guessing there's obviously going to be advantages to your program.
Yeah.
Which you wouldn't
So,
exist,
we're non-recourse. So that's one thing.
What does that mean? To
Means
the
that
consumer.
you don't have to personally guarantee the repayment of the loan. So
Okay.
with your mortgage, you'd probably, whether you have a trust or whatever, you're signing somewhere to say, if I'm going to make these payments for the next 30 years, and you could give the keys back to us if things don't go well. It's not that easy, but it's pretty close to that. So we're totally relying on the real estate versus having like this guarantee. So banks pretty much require personal guarantees when you go to borrow money from them. So think if you're a fundraising real estate entrepreneur. So you're let's say, again, a $15 million property, and you're putting in 5 and I'm lending you 10. Let's say you don't have the 5, but you go to your buddies, and you pool your money together and they get a piece of the deal, and you put in 300, 400, 500,000 of that 5 million. You don't want to sign personally. Those guys aren't going to sign because they're, you just pitched an idea. They're going to be relatively passive.
Fair.
And you're going to have to, in the bank world, you would sign personally for that whole 15 million, but you've got 500,000 in the deal. Now, I don't want to make it easy for you to just say, Art, take the keys back. It's not. That's why I said it's not that cut and dry, but it's pretty close. The 5 million of equity is in lieu of your guarantee from our perspective, and we believe that that's enough skin in the game that you'll stick around. And then on the bridge can be more extreme. We could have a boarded up property. Let's say it burned down and the guy took the insurance money and left it all boarded up. New guy comes in and says, I think there's a real canvas here to do something special. Just to have, it's going to take longer to do it, right? there's more work to be done. So, you know, you got to finish up the framing on the outside and put a new facade on, and maybe put all the units in and make it brand new. And so all that will take more time, and you don't have any income coming in while you wait because the building's empty. So the bridge can be shorter or longer depending on how you look
What's
at
the
it.
longest you go? 3 years?
Yes. So you'll see a lot of bridge construction lending is effectively a bridge. You've got a piece of ground and you're going to build a building on it. And the bridge period is the time it takes to buy the property, top off the very top of it, fill it up, and then go on to wherever it's going to go. So most developers in real estate, and stereotype a little bit, but they are generally not in it for the long run. Funds and things, you know, they have a 5 or 7 year window. It's build it and flip it, you know, move on to the next one because it is so capital intensive. Take your profits, plow it back into the next one. Hope, you know, maybe keep a little for later, but
You're doing a big one in Naperville right now, aren't you?
I am.
It's right here, isn't it?
It
Right
is.
at Ogden
Yeah.
and
Iroquois.
what's going on there?
That's
a little different than the story you're getting.
yeah.
Right
So
now.
that's a little longer bridge.
Okay.
The center's tired, and the concept that area was sort of neglected. There was a big shopping center that, you know, had virtually become vacant. There was a movie theater at that old center, and our center was sort of just another wave. As you go farther west on Ogden, for those of us in the western suburbs of Chicago here, just kind of loses some steam on the retail attractiveness. And our center wasn't a driver of, you know, didn't have destination tenants who were going to keep going down farther west to get to that point. But, you know, lo and behold, Costco, the good thing about Naperville is it's a growing area, it's desirable, and large tenants like Costco want to be in the center or want to be in the neighborhood. So Costco took that old center that was next to ours, or the one I'm going to lend on, and demolished it and put up a brand new Costco with the gas station. The gas station faces our center. It's one of the things I'm really excited about because I think there's one way out of a Costco gas station, and when you get back in your car after you fill up the tank, you're going to be looking right at our center. So everything that faces that exit on the gas station should be great. But, you know, the center is maybe 56% occupied, the one I'm making a loan on. So it's kind of the next phase of rehabilitation. There's a big franchise, that famous chicken franchise that hopefully will be coming to the property. They've gotten approval for a double drive-through in Naperville.
Are they open on Sundays?
No.
Okay.
And they
don't mind. That's the projector.
okay.
Can you edit that out later, Dave? Probably not. We'll get over it.
So they're going to demolish 50,000 feet. They're going to redo the facade. They're going to make it look much more modern. The center was built probably in the 80s, I think. And
but your experience is not just in production or in producing, right? You've got experience in underwriting, producing, and we're also
portfolio management.
And portfolio management.
Yeah.
So I guess you're kind of a layup for the president position. No, I mean, there's not a lot of people with your experience in this industry, are there?
No, there's more than that. You know, I've seen a little bit of everything. I've been through several cycles, so it's sort of, you know, I think having a little gray hair in this business isn't so bad. You go through, you know, things that go wrong, and we've had such great, you know, the United States is an incredible place. We have these boom periods or growth periods, and we're in one now. But one thing, you know, if you never saw what can go wrong, you have no idea. You don't think you can never make a mistake. And what I tell my students is the same thing. Like, if you work at a bank, you're lending depositors money. I mean, that's when you go open a checking account, you're giving the bank your money, and they're going to put it to work. And that's why the government is so restrictive on banks and puts all these rules in place. And they keep making it harder and harder for banks because they've gone, you know, these bad cycles. We learn something every time what went wrong, and again, why does the government care so much? Because it's consumers' money, and the consumer's money could potentially be lost. The government's insuring 250,000 of your deposits, so they have a vested stake in this. But if the bank goes and takes the depositor's money and goes and makes crazy, stupid loans, if there's some new bank that opens up tomorrow and just does every office building in Naperville here, the government's going to have a real problem with that, because the risk that the bank is taking is way in excess of what they want banks to take in relation to the fact that they're providing insurance to the funding source, which keeps the funds cheap, and provides a system that makes everything work in America. So we need a sound banking system. When we had a year and a half ago, early last year about this time, when a couple banks failed, as Silicon Valley Bank and New York, Signature Bank in New York, the stock market plunged 1,000. We thought there was going to be this, contagion of other banks failing, and the Federal Reserve stepped in and said, "We're not only going to insure 250,000, we're going to insure everything you got." And it was a temporary thing, but because
It's probably a good thing.
well, you have to install confidence in the banking system. Otherwise, what happened? Signature Bank and SVB, Silicon Valley Bank, didn't fail because they made bad loans necessarily. They failed because every customer became panicked. And I don't care if it's JP Morgan. If every customer at JP Morgan in the next 2 hours decides to pull all their money out of the bank, JP Morgan's going out of business. Now, it would take a lot more than 2 hours. But now with your phone and everything, if you Reddit room or had a meme or something, and you said let's go screw around with Silicon Valley Bank, which is almost what happened.
Wow.
The word got out on the internet that there was trouble, and then Silicon Valley not only was paying all these deposits out as people panicked. Silicon Valley was a little different because it was a tech-orientated bank, so you had all these companies in SoCal or NoCal who were like, Roku, I think, had $492 million in their checking account or something like that. So well over the insured amounts that were available. And interestingly, Roku never pulled their money out, but many did. And then I think if you had $1 million at that bank, you filled, and you had 250 of insurance, and the word was out on the internet that Silicon Valley's going down the tubes.
Yeah, transferring.
You're going to at least get 750 out of there, and probably sometimes the Fed doesn't give you your 250 like tomorrow.
I read it take place over 40 years FDIC. Am I right?
Yeah, I didn't. You said that the other day, and I don't know that for a fact, but so that's really in the and then it sort of contagiously went over to Signature Bank on the other side of the country, and they also had a lot of crypto customers and things who had big deposits at the bank. They weren't taking crypto money or whatever it is, but they were taking people who were involved in the crypto business. They were taking their cash or something. The government didn't like that anyways, so I don't think they were in any mood to save this bank when it hit the fan. But same exact thing happened, 24 hours later. Where's the next bank that's going to, somebody sends something on the internet, they're in trouble. They've got this problem or that problem. All these customers with, excess deposits. I actually bank with Signature Bank. My company does. And he told me that they had something like $18 billion go out the door on Thursday afternoon. That is just a killer.
It's a big deal.
Banks don't keep their entire balance sheet in the vault. They go lend it out. Banks have very little cash in the vault relative to the size of their bank. So if you walk over to your local bank tomorrow and they're a $500 million bank, they probably have 10 million, 15, 20 million, maybe a little more than that in cash. They have access to cash from the Federal Reserve, but they don't keep cash in the vault. They would lose money because they're paying you interest on your deposits, maybe not your checking, but your passbook savings.
Not much.
Yeah. So they've got that's what the business is, right? They take your money, you walk in the door, you say, I want to open a checking account, Miss Banker. And she says, great. And she takes your $10,000 and then she puts it in the vault, and then the guy takes it out of the vault and lends it to somebody else for a car loan at 7%. You get 2, they get 7 using other people's money, and it's all. I don't care what business you're in America. Generally, that's what happens.
We talked a little bit about when we spoke, I think on Thursday or Friday, about negative cash flows and how these moving interest rates on some loans today are putting consumers or business in a bad position. Can you tell us a little bit about that?
Yeah, really, it's what happened is 3 years ago. During the pandemic, the Fed, in order to stimulate the economy, the Fed is a big stimulator or non-stimulator, depending on what mood they're in.
Right.
Had just realized that with 25% unemployment and some, just what unknown catastrophe that we haven't seen in 110 years or whatever it was since the Spanish flu, that we had potential for a devastating situation greater than the Depression. And so the Fed said, we're everything we can possibly do to keep the economy going, we're going to do. They cut rates almost to zero, like in no time. They bought mortgages, did everything possible to stimulate the economy and to avoid potentially depression. They've all seen the playbook. The great thing about history is it teaches us, what maybe somebody did wrong in strategy and all that. So people who study history, whether it's American history or financial history, hopefully it teaches us something. And so they went to the playbook of what the Fed did during the Depression. Certainly rules were different back then, but they sort of played that playbook. And it worked. The economy stimulated. This work from home thing, thank God for technology.
Yep.
We have computers that we didn't have in the Depression, and we could still create commerce and make transactions happen. And obviously, if you worked at a restaurant, you were out of work, but you could, still buy real estate potentially. You might not be able to look at it, but you could have bought real estate, and there was things going on. And certainly, if you were selling assets out of a warehouse like Amazon, you did really well.
You did very well.
But people still got paid for the most part. The government stepped in, did PPP and all that, and the economy was able to chug along. Well, we get out of the pandemic. The Fed, I don't know, exactly what were they thinking at this point, but when the economy starts picking up, people are coming back to work and physically. They're going back out to the restaurants, so forth and so on. Remember, America had saved a lot of money during the recession, and we were, had nothing to spend it on. You couldn't go on travel. Maybe you bought, something in the house, some new Wii system or something to play around or whatever you did, or, but you saved a lot of money. And if you got PPP because you didn't make enough, or whatever it was, this government checks that they were writing, you built up some savings. You had some money to spend.
Yeah.
So Vegas opens up. You're able to fly there. The hotels are available to go to. You see planes full of people who are going to Vegas, and nothing wrong with that. That's fine. But the Fed didn't really pick up on that. They thought that inflation was happening, no question about it. Planes went from zero to expensive a flight. Hotels maybe not so much, but food was definitely going up.
So do you think interest rates should have climbed a little bit quicker?
Yes,
You think you
definitely.
do?
But anyways, so real estate is getting bought. When interest rates are low, people go and they go buy things, that they otherwise might have to borrow money to do. So with houses, you saw young people going out in droves buying houses, creating bidding wars on real estate. Mortgages were 2.5%, 3%. People refinancing out of a 5 or 6 to a 2.5. What does that create? That creates disposable income. Their payment goes down, and they go run. They go run on vacation. They go buy things, whatever it is they do. And the Fed just didn't see that happening. And so, but in the commercial real estate business, the business I'm in, same thing. Everybody was buying apartments. Nothing was built during the pandemic. And this concept was there's a housing shortage, and I could borrow money at 2%, 3% from my bank because the base borrowing rate was zero basically, and maybe the bank or whoever the lender was charged $250 above that. So you're borrowing at 2.5%. So you paid top dollar because you could borrow so much money cheaply, and that happened all through sort of the 2020s, the early 20s. And then suddenly the Fed got religion, and last year, starting in 22, but really in 23, said inflation is not transitory; it's real, and we gotta stop it. And it's because inflation hurts the poorest people the worst. It's a regressive tax. They don't have a bunch of extra cash. They don't make enough to offset the increased price of goods, and so the Fed knows that. It's the playbook that, again, we go back to the 70s. We talked about it in our pre discussion. Inflation was really dreadful in the 70s. That Fed chairman took rates up to 18%. And he knew what the consequences of that would be, that he'd cause a recession, but he knew that runaway inflation was problematic, and a lot of that was caused by oil. And oil, there was an embargo against OPEC and all kinds of things going on back then. But so he took rates up to 18%, took them back down in a hurry once he solved the problem. But at 18%, nobody bought anything. People lost their jobs, transactions weren't happening. And he knew that was a consequence, but he felt that fighting inflation was more important than, keeping people employed for a short period of time. So I think there was people wearing buttons like "whip inflation now" or something like that. I was only 7 or 6, but so then we go to Chairman Powell, who's in today, and he doesn't have to take it to 18 to slow things down, thankfully, but he takes it up from 0 to 5. A 5% increase in 7-8 months.
It was
incredibly
quick.
Steep. Yeah,
It was quick. Yes.
If we had the curve, and I could show it to you, but the incredibly steep increase. So now people who borrowed on a floating rate basis they saw their interest rates go up 5%. So if you take a $10 million loan, that's $500,000 extra in debt service. If you budgeted that, and there was no indication that the Fed was going to do this.
Well, they announced it, didn't they?
They said it was transitory. They weren't going to take rates up. There's something called the forward rate curve that we all look at that we should never look at, because it's just absolutely
okay.
Yeah, it's more like you might as well just walk into one of those future readers or whatever.
Oh, okay.
With the
A psychic. Yeah. Okay.
And because it's just worthless. But I could show you a chart on it. But so we thought the rates would only go up a little bit. Banks underwrote some stress in interest rates, but very little. But they didn't underwrite a 5% increase. And so all the people who bought these assets on the basis that debt was going to be cheap suddenly saw that their payment was going up. And they even if they could fill up the building,
you only raise rents so much on your consumer, right?
That's right. So some of these assets in multifamily, particularly, they're full, but people are selling them at a loss because the buyers just can't make the numbers work at today's interest rates. And so it's part of real estate. I'm fortunate because my company wasn't really doing a whole lot of lending during the pandemic. We were sort of on the sidelines, but we reopened up. And so we came in on the tail end of sort of the rate increases. So we know where rates are going. We're looking at things, and it was more luck than anything. If you were like me and you said, "Oh, rates, I just don't want to make a loan because rates could go up 5%," you'd be out of business. We happen to make the decision not to make any loans for a variety of reasons. But but now we've got issues in apartments like insurance. So we're constantly fighting these new problems, and maybe you could talk about what's going on. But we look at apartments in Florida and California and the coastal areas, and it's like, besides all the other challenges that are facing commercial real estate, now we've got insurance expense that the customers don't, again, with the rent, you can only charge so much.
Yeah, well, property casualty insurance premiums are climbing at a rate that I don't think we were even prepared for. It's certainly not the consumer and not the lender. And you even see some insurance companies pulling out of markets altogether, right? You mentioned Florida. I mean, you've got companies that are just leaving, and there's some companies that, as of late 2023, early 2024, just said, we're not writing any more business, even if it's writing a homeowner's policy in the Midwest. So I think whatever's happened has caused a lot of pressure to everybody, right? There's downward pressure on the consumer. There's downward pressure on the insurance companies. And couple that with the Department of Insurance increased reserve requirements too. So when your insurance premiums are going up, it's also because the Department of Insurance is requiring that we're holding on to more money in case of a, another catastrophic loss. Because weather patterns have changed too. So
Right.
there's all types of pressures everywhere in the economy, right? And it starts with banks and interest rates and ends up with your auto insurance premiums.
Right.
So I think it could be frustrating. But where do you once called yourself a closet economist, I think is what you said to me jokingly.
Well, you took some good notes. Yeah.
Well, or maybe what you said just resonated, right? But where do you think we're going? And I
Yeah.
understand your line of work is doing bridge loans and make sure
Well,
that
I think if this is April 16, 2024, rates have climbed relatively dramatically the last 6 days.
they have.
Uh,
And inflation came out last week, or it might have been the week
inflation's-
before. But
Inflation is hotter. Um, again, for Chairman Powell, and I sort of get why he would reduce rates. You shouldn't have rates that are much higher than inflation. That's kind of the playbook. But the economy generally is relatively strong. I am a little worried about how frothy sort of the stock market is. AI, I don't know enough about it, but I sense that it's going to be a game changer. And you've got a product that could be the cell phone and the home computer, the PC. It's like it could change the way we live. It could change the way things are made. The technology's been out there, but it seems to be like getting more refined into something that is gonna change productivity. And so I get why the stock market is way up. I get especially the companies that are involved in that business. But I think it's creating a lot of wealth, and that'll offset the sort of the hardships that I think there's a bifurcated economy too. I think people at sort of the middle level and a little bit lower, they're hurting. I mean, they're just getting by. I think if you go to the grocery store, and I do, it's $6 for a 12-pack of Coke or whatever, and it's a bag of Tostitos is like $5. And I had a gap where I wasn't going to the store as much, and I'm like, what in the world? Like,
Yep.
I like Fresca. I drink Fresca. It's like I like
So it's insane to drink
Fresca.
it's good
But
with
it's
good with
you
tequila,
can't-
by the way.
it's- Yeah, and
I learned that in
and vodka,
Cancun, but
and vodka. But it's like $8 for 12.
yeah, it's crazy.
And or if you buy 4 of them.
So how much?
I live in a 1,200. I was living in an apartment at the time. I'm not going to buy 4 Frescas for $27, get the $5 discount or whatever it is. It's
So how much more pressure do you think is going to be applied before maybe there's a little bit of easing on the consumer? Because if there's one thing I've learned in my line of work is it seems like everything gets passed on to the
is
consumer.
AI going to help? I mean, I don't think it's going to make chickens lay more eggs or whatever, but it's going to do something to the farming community. I think the farms is one place I've heard it's going to be more productive, so that's good for food. Ukraine is a factor. I mean, who knows what it doesn't look good right now. I don't, I'm not going to start talking about, war strategy, but it seems like Russia's taking over, winning a little bit more. There's a lot of agricultural product in Ukraine, and we've survived it. We've overcome it. The war is now over 2 years old, but it could be a factor down the road. I think it's the largest producer of fertilizer or something in the world. If Russia takes over, if they get it, they'll control the product. And a lot of times these things are fought. These wars for maybe not in Israel, but a lot of these wars are fought for economics, not for power and that too. But a lot, I mean, someone decides to go jump on Iran, there's a lot of oil they could get
There
out of
is.
it. Now, there's also we don't want that obviously, but so no, I think we got to get. I think the Fed's on the right boat, and I think AI will help with inflation.
What about short term though? So
Short-term
I
is
think the
there's gonna be
Fed
pain,
the
yeah.
Fed said rates are going to come down a little
Yeah.
bit. I think that was their most recent announcement, right? Did they say when?
Well, now it's maybe one cut this year.
One cut?
Yeah, if you look at the chart, the forward curve again, which I said doesn't have a whole lot of meaning, but it's the best we got. I think is maybe 375. The current short-term borrowing rate is maybe 5.25. So by the end of 2025, we should be at 375 if you believe that chart. I don't. It's not even
Well,
worth
oh, if
talking.
the chart's right, that would be good because you'll get another refinance boom, right, in the
Yeah,
consumer
yeah, certainly
in the
help the
consumer
residential
real estate
mortgage
business, right?
persons. Yeah, and that's a big, housing. Young people can't find a house to buy. No one's selling because they have cheap mortgage. They don't want to get into a mortgage at 7% or whatever it's at today. So if you've got a 3% mortgage, you're not selling because you just, it's not like you're getting a deal. There's this whole shortage. It's sort of a
Yeah.
self-fulfilling thing. There's a shortage of housing to buy or stock, and so young people are trying to get out of apartments, can't find a house to buy. They're even willing to pay the 7% mortgage rate, but there's just no product, and it's getting either bid up or it's it's not what they want or whatever. But generally, it's not much of a value right now. But it's really the bigger problem is there's a shortage of housing.
Yeah, it's
But I don't. The housing market is fine. I think people, it's healthy. There's not a lot of construction, and when maybe there'll be a boom, but I just don't. I think the housing market. I think we're always going to have a shortage of housing. The days of the massive. You're old enough to remember. You get the Tribune on Sunday 15 years ago, and the real estate section had ads from these guys who were building like 1,000-unit, farm acreages out, here in suburban Chicago, out in Montgomery and Plano, and uh,
I remember.
yeah,
I remember clearly. I was in my early,
yeah.
mid-30s.
Manhattan down south, and there was 11,000. I remember talking to somebody. There was 11,000 units in the docket in Manhattan at one point. I mean, that would have changed. That would have been.
I had a bunch of friends that I had friends that
Yeah.
went down there. So
And all that stuff
yeah.
went out the window with the recession, and it really never came back. Those builders really were down to sort of a monopoly of big giant builders. I mean, there's the little guys, relatively little, and then there's the big Pultes and Toll Brothers, and there's really no people in between. And those were the ones who were building in Montgomery and Plano. And
so what is
so
that?
I think there's going to be a short, and people don't want to live that far out anymore either. So
What do you think the future holds then for your industry? I mean, are we going to continue to see areas being improved, the Naperville lot, right, that lot being improved, bringing in new retailers? What does the future hold for you guys?
I'm bullish on commercial real estate. I mean, maybe not office, but I think there's a shortage of places to live. We do, we're going to see some population flattening. I think I forget what cohort it is, but it's like 10 to 30 or something. We just didn't have a lot of babies being born in the United States back then. Immigration is a big, no one exactly knows how many people are in this country right now and how many just have come in. It's not the end of the world. We need more people in this country. We need, we didn't birth enough. So this is going to help. But they need to be in here legally. And I don't even understand what's going on in the world today. But
we need more housing
we
with
need to
the influx of immigration,
that's too.
legal
So,
or
yeah,
illegal. We need more housing.
Yes, totally agree.
Because we can't have people on the streets.
Yes, but more people means growth generally. So
fair.
Whether it's in Naperville or it's in the border areas of Texas or wherever it is, eventually, if we settle these people just like we did in the World War I and II or whatever, put a Statue of Liberty Part 2 down there and figure out a way to get them in here and be legal or visas or whatever it is, expedite the process. We need more immigrants. It's just we do. There's nothing wrong with immigrants. We shouldn't allow people coming in illegally who aren't paying taxes who are getting the benefits.
What does that mean to your business? Like, what does that mean for bridge loans? I mean,
growth in the country is good, right? For people shop, they rent units.
Okay.
Industrial properties that deliver goods to the grocery store or whatever department store need to be filled up with inventory. Plano eventually becomes Plano, and Manhattan, Illinois becomes Manhattan, Illinois. That was supposed to be.
Yep.
We need growth. I mean, that's just whether it's in Illinois or in a state where there's no taxes or whatever. But we need more people more taxpayers help you and I and Nick pay less taxes. Florida, it's not like rocket science why Florida doesn't have an income tax. They got growth, right? Why do we pay more property taxes here? Because we have people shrinking. The same spending goes up, number of people paying goes down. That's why taxes go up.
Well, I left. I mean, I'm proof of it, right?
Right.
We just bought in Tennessee,
Yeah.
so
So you went to a state where people are moving to. Now, it's if you look at the migration in this country, it's moving away from places where there's high taxes. There's some argument to schools and things like that, and I'm not going to disagree. But Florida and Tennessee and some other states with low taxes, they can afford to raise taxes a little bit. It still will be significantly less than what's happening, in the big tax states. And we have, our government has a spending problem, depending how you look at it. But we just can't solve everything with government spending. That growth will help all that. People who are impoverished.
so that's good. That's
people
good.
who are
That's good for your
impoverished-
business.
Yeah, it's good for everybody's business. It's good for your business. If anybody, you're a consumer.
I am consumer driven.
Yeah.
I'll tell you what, though, I think our industry has probably changed forever. I do. I think the future on the insurance side, not the security side, but I think on the insurance side, both for the residential consumer and my commercial clients, I think insurance is going to be viewed very differently and probably purchased very differently in the next 5 to 10 years. I think it's already happening. What we've seen is an influx in claims, right? An increase of claims. We've seen weather patterns change. In the last, I think the company I'm with right now, we've been in business since 1925. Our top 2 biggest claims in the history of our company happened last year. And so you couple that with increased costs, right? Everything costs a little bit more. Chevrolet or whoever, they're charging more for fenders, and there's a little bit of a longer delay on parts, which means rental cars are lasting a little bit longer. So I think that the American consumer, if we continue to feel the pressure where we're at, we'll just have to self-insure for a little bit more. We'll just have to do it, which is tough.
Yeah.
We talked about the consumer pressure a second ago with
Right.
you. What happens when the homeowner has a $10,000 deductible? And that big claim happens, right? Now you're talking about going
And
to lines of
that's the challenge with
that's the challenge.
consumers, right?
It's
When
the
you're in the
gap.
consumer business, the government gets very politically pressured to.
Probably.
So my position would be like, it's capitalism. You can't have, if there's hail damage on the roof, maybe we got to say we're not insuring that anymore or something.
Well, those things
I
are
told you a
happening.
story.
It is happening.
I just I have a place in Florida, and the roof was 20 years old, but the hurricane had done damage to it, and the insurance company's position was, this is a commercial property, it's a homeowner association, but their position was, hey, it's a 20-year-old roof, we're not going to pay you nearly as much as a full replacement. And our position was, wait, the roof was in great shape, but the hurricane did the damage. And when it comes to a home, if the insurance company say we're getting fleeced by these storm chasing roofers, and they're just killing us, we're having these enormous claims for roofs because every time it mildly hails, they're up on the roof and they're saying there's damage, and there might be
some soft
but
metal.
it's maybe those claims are just out of touch with the premiums that are being paid. And you guys say you want to hail, it's going to be a special rider, you got to pay for it. Now the government's going to be like, you can't have people who have these hardships of having to get a new roof because there's a hailstorm and they didn't know they had to get a hail rider or whatever. And that's the problem with your business, and maybe the problem with the government. They sort of overrule capitalism, right? It's like nobody, a flood happens and people don't have flood insurance, and you pretty much have to have it if you're in a flood zone. But let's say you're not in a flood zone and we have one of the climate change storm, and the houses get destroyed, and the guy, the insurance company says, hey, you don't have flood insurance, I really feel bad for you, but whatever. The government kind of is going to come in and go, I want someone to pay. Well, it's not fair to the insurance company. They didn't, they charge a premium, that's their business. You pay for avoiding risk. And if you decided, well, I'm not in a flood zone or whatever, no one told me it could ever possibly flood, the government's going to say, yeah, we feel bad for you, and the government's got to write the check, which means we all pay, or they force the insurance company to be more aggressive on their claims paying or something. I don't know, but that's the problem with consumer businesses to me sometimes, is like suddenly the government is like changing the rules every 5 minutes.
So I think that
because they care. They don't want human beings to have hardship.
you're probably onto something, but my perspective is probably a little bit different. I think the big breakdown is just who you hire to be your who you're hiring to manage those policies for you.
Yeah.
Totally. It always comes down to communication.
Absolutely.
So if the government does implement a change or the insurance company has to implement a change, I think as long as it's clearly communicated and then sadly enough in this world documented, but I think we just need to make sure that we're removing the element of surprise from the consumer. I think consumers are better protected if they could be prepared, right, for that once in a lifetime event that happens.
Right.
I think the industry will change. We've seen on the commercial side of things, we've seen insurance companies leave the habitational risks. So it's very difficult. You see a lot of roof endorsements because the claims volume is just too much,
Right.
whether it be weather pattern or cost of goods. And my numbers could be off, but I think on the homeowner side of things, a little bit off of what we started out talking about, but I think the average industry payment was like $20 billion. Last year it was $30 billion the industry paid, and this year we're already on pace to pay $40 billion in claims. And so it always it's downward pressure. It seems to always fall back on the consumer, which is why I think that ultimately people have to partner with their agents, treat them as an advisor or as a consultant as opposed to a sales rep, and say, well, what's the way to work around this? Understand the policy. You talked about contract language. From what I've seen, I think contract language is getting more and more specific in insurance contracts for that exact reason. Right? The attorneys are making good decisions, and I think it protects the consumer, but I also think it protects the insurance company. I may have a biased opinion. I think I represent the consumer and not the insurance company.
Absolutely.
I do believe that, but we do have to work together to protect the insurance company too, because as their costs increase, so do ours. It's just the nature of the beast. So I think a good partnership, understanding what we need to do moving forward, and maybe taking more insurance. That self-insurance piece, which is a deductible, right? That's all. When I say self-insurance, it's simply that.
I think that insurance is always a commodity, right? Until there's a claim, right? And that's when someone like you steps in and says, "You're going to work with the claims adjuster. Maybe you don't have a."
Not a ton of pull anymore.
Dictator control,
we used to,
but you can make some calls and you can do the best you can for the customer. And so, the problem for most consumers, from my perspective, is they think insurance is a commodity. They've never had a claim. Young people who have decide, to go rogue on home insurance, which they can if they have a mortgage, but go rogue on health insurance or whatever. That's all fine and good. I get
you need it.
Why am I paying $5,000 a year in health insurance when I never go to the doctor? It's why do you buy life insurance? It's you hope to never die, right? Or but it's understanding that it's not necessarily a commodity, and certainly in life insurance, if it does, God forbid, something happens, you want someone like you that's going to go deal with the claims adjuster and make sure the person gets their money sooner than later. Yeah, exactly. And you're in a car accident, you want to make sure the guy gets, the car gets fixed, right? That's how you get to work or whatever. And I say it all the time to people, like, Geico or Progressive or whatever. That's all fine and good if they're cheaper. But go wait. Call me when you got a claim.
I think you're onto something. I think we need to find some way to talk about bridge loans today. We have to bridge that gap between what's dirt cheap and I really don't have much protection, and what's top of the road, what's super expensive to where I can't afford it. Right now, I feel like maybe we're at one extreme or the other in the American household. I think we just need to find that happy medium, and I just think it comes from a place with a greater understanding of our contracts and probably understanding how much we can self-insure for. But business owners in your world, I think they have the same risks or the same challenges, not risks, right? They see their costs increasing too. Yeah. You talked about being negative cash flows. What happens when you're a commercial business owner and their property for their building goes up 30%, 40% one year over the next? Right. That puts downward pressure too that ultimately gets, I think, put into their product or whatever their consumer is buying.
Well, what I sell to my customers, we're not the cheapest by far. There's always money is a commodity. I mean, if you don't have it, it is. But my money's no different, the same color green as everybody else I'm competing against.
True.
The price of that money is maybe more for whatever reason that I have to get more yield on my loans. But the way it gets complicated as the dollars go up. So there's people sell loans, and certainly you might see it in the mortgage business or residential mortgage business. You close your mortgage, and 3 days later you get a letter from somebody and says your loan's been sold to this guy, and then
24 hours.
2 weeks
24
later,
hours
it's
is sold. Yeah.
So these servicers are just selling your loans. The originator sells it, and then maybe the servicer decides they sell it for some reason, and you get 4 letters in a month, and then you're trying to call somebody to get a payment book or set up your ACH or whatever. But and the same
All
thing
true.
happens in some degree. It's different, but in many ways it's not. So a lot of my competitors, they will outsource the servicing of the loan too, just like in the residential mortgage. And so you've got a problem with your asset, and you're calling some hired gun in Kansas City who's like, yeah, I'm managing your loan, and the loan agreement says this, and we're not going to be flexible with it. And it's a little bit extreme, but it does happen. And you with my company, you get me or one of my staff, and we deal with issues. Remember, we got to get across that our goal is to get this bridge built effectively. So it makes no sense for me to stop construction in the middle of the bridge. Now, I mean, if there's bad things happening like fraud or something, but
Sure.
generally, if everybody's acting on the up and up, and we see a light at the end of the tunnel, which is the bridge can be built, we'll do everything humanly possible to work with the borrower to get that bridge built, because you can't get across the river without it.
Amen.
So once it's built, at least then we've got sort of some of the complexity of the story down to where, hey, we've got a full apartment building. It's all brand new on the inside. The income might not be enough to pay my loan back in full. Maybe between the borrower and myself, we'll figure something out. Luckily, I haven't had the problem where I've taken a loss, as I said, but we'll work something out. We'll buy more time or whatever. Maybe you guys pay the loan down. I'll give you more time. The economy will pick up, or the market will pick up for apartments, and we'll move on to the next project together. And that's what we sell, is that we keep the loans in house. We sort of handle the problems accordingly, and I think that's the reason why we didn't lose any money. And since the Great Recession, we've been undefeated, sort of. Again, knock on wood. But
that's
and
cool.
I think we do a good job.
Great.
I think we do a good job of evaluating the deals.
Now, you guys had different divisions, though, right? Did you do some residential stuff in the past, or am I wrong?
No, Inland has never really done
Okay.
anything with sort of consumer lend.
Okay.
Now we've
Well,
always.
you had other divisions, though. You weren't just in bridge
Yeah,
loans.
we built another part of Inland builds apartments generally,
Okay.
some hotels.
Okay.
Mostly Inland buys commercial real estate and brings investors from inside who are passive, and they'll invest in Inland products, and we'll take care of the management, and we'll pay them a dividend and give them their money back at the end.
Cool.
And that's what they want us to do. So they want to return. They don't want to be bothered, with the day-to-day stuff. And hopefully, we buy good assets. We take care of it. We maybe increase the rents over time. Then we sell it, and they get their money plus, and they made a dividend while they wait.
What's the smallest loan that you're doing right now?
Probably, well, we would do 3. We don't have many of them.
And
it costs a lot to do a transaction.
What's the most you would?
Oh, 15.
So 3 to 15 is
Yeah.
kind of your range right now that you're lending in?
That's right.
All 50 states?
We're not too big on Hawaii and Alaska. It's really just
Okay.
not worth it for.
So we'll say
15 million.
48.
Yeah.
48 states.
Yeah. If trying to go to Hawaii to look at the property and to get someone.
That sounds like the best part of it to me.
It is. But except if you're going for a 3-day trip to go look at the property, but then you're exhausted on the way back. But no, it's the vendors who we monitor. We have to monitor the assets while they're under construction or whatever, and trying to get people to go to Hawaii is just, it's not, it's a difficult place to get to. And I don't think I really realized it till I did a deal there. it's it's a 4-hour flight from the mainland, and people aren't just there's not a lot of like professionals who are working in even if you're in Honolulu and you have an office there, if you're going to Maui or Oahu or whatever, you got to get on a plane. And it's not like, I mean, it used to be a boat. I think you could go from island to island. They got rid of that because I guess the whales or something where there was some environmental issues. So you've got to take a plane to go from island to island. I was sat next to somebody who was going to Costco and had, I forget how she did it, but she basically was shipping the groceries that she had shopped for and was flying back to her home. And I was like, that's got to be the most. I mean, when I go to Costco, I end up spending a lot more than I thought.
That sounds.
But you beat me.
She's yeah.
You spend $300 on Hawaii Airlines plus whatever you spend at Costco.
That must have been. That can't be your normal grocery shopping.
No,
can it? I mean,
when you go to Costco, I got to believe it's once a year. It's like, and you get. I don't know how they ship it somehow because then you got to pay FedEx or whatever. But
no Instacart in Maui. Then is that what you're telling me?
Yeah, good luck.
Yeah,
if your Drizzly's gonna deliver you some whiskey,
right.
You better plan on a couple of weeks in advance.
Thanks for coming today. We should probably do it again.
Yeah.
In fact, during Coffee Talk, you had helped me do a presentation one time. You talked about bond yields being inverted.
Yeah.
You talked about the impact that's having, right, just on our general cost of goods. And maybe we come back in 6 months or a year and we revisit what we talked about today. Yeah. Let's see what the Fed do with rates. Yeah. Let's see where I want to find out what's going on with that project in Naperville.
Okay.
And then let's talk about some of the other stuff that we've done together.
All right.
Cool.
Sounds great.
All right,
I love
thanks
it.
for coming.
Thanks. You bet.